a remarkable tightening of operations, and the sale of businesses deemed non-core by Anders' strategic framework. In operations, Anders and Mellor found a legacy of massive overinvestment in inventory, capital equipment, and research and development. Together, they moved quickly to wring the excesses out of the system. When they visited an F-16 factory, they looked around and counted huge numbers of expensive F-16 canopies, the clear glass covering for the cockpit, in a facility that made one plane a week. Mellor's new rule? A 2-canopy maximum. They found duplicate pieces of expensive and underutilized machinery in adjacent tank plants. Mellor combined the facilities. More generally, they discovered that plant managers carried far too much inventory and hadn't been calculating return on investment in their requests for additional capital. This changed quickly under Mellor's watch, and he and Anders moved decisively to create a culture that relentlessly emphasized returns. Specifically, as longtime executive Ray Lewis says, cash return on capital became the key metric within the company and was always on our minds. This was a first for the entire industry, which had historically had a myopic focus on revenue growth and new product development. Importantly, this new discipline affected the company's approach to bidding on government contracts. Prior to Anders' arrival, the company, like its peers, had bid aggressively on a wide variety of contracts. In contrast, Anders and Mellor insisted the company bid on projects only when returns were compelling and the probability of winning was high. As a result, the number of bids shrank dramatically, and the company's success rate rose. As longtime industry analyst Peter Aseridis says, Anders and Mellor brought a new focus on shareholders, a first in the defense industry. In the first 2 years of their regime, Anders and Mellor reduced overall headcount by nearly 60%, and corporate staff by 80%, relocated corporate headquarters from St. Louis to Northern Virginia, instituted a formal capital approval process, and dramatically reduced investment in working capital. As Mellor said, "For the first couple of years we didn't need to spend anything. We could simply run off the prior year's buildup of inventories and capital expenditures." These moves produced a tsunami of cash, a remarkable $2.5 billion, and the company quickly became the unquestioned leader among its peers in return on assets, a position it holds to this day. Which brings us to the other larger-than-expected source of cash at the company, asset sales. While Mellor was wringing excess cash from the operations, Anders set out to divest non-core businesses and grow his largest business units through acquisition. Interestingly, as Anders met with his industry peers, he found that, as a group, they were more interested in buying than selling. He also found that they were often willing to pay premium prices. The result was a dramatic shrinking of the company through a series of highly accretive divestitures. This was a first for the company and for the industry. In the first 2 years after taking the reins as CEO, Anders sold the majority of General Dynamics businesses, including its IT division, the Cessna aircraft business, and the missiles and electronics businesses. The largest of these divestitures, the sale of the company's dominant military aircraft business, presented an unexpected challenge to Anders' strategic framework and is worth looking at in more detail. This transaction actually began as an attempt by Anders to acquire Lockheed's smaller fighter plane division. When Lockheed's CEO refused to sell and made an extravagant counteroffer for General Dynamics' F-16 business, Anders faced a pivotal decision. It's worth pausing here to make a more general point. Most of the CEOs in this audiobook avoided detailed strategic plans, preferring to stay flexible and opportunistic. In contrast, Anders had a very clear and specific strategic vision that called not only for selling weaker divisions but for building up larger ones. After making early progress on the sales front, he turned his attention to acquisition, and the military aircraft unit, the company's largest business, was a logical place to start. On top of the economic logic of growing this sizable business unit, Anders, a former fighter pilot and an aviation buff, loved it. So when Lockheed's CEO surprised him by offering $1.5 billion, a mind-bogglingly high price for the division, Anders was faced with a moment of truth. What he did is very revealing. He agreed to sell the business on the spot without hesitation, although not without some regret. Anders made the rational business decision, the one that was consistent with growing per-share value, even though it shrank his company to less than half its former size and robbed him of his favorite perk as CEO, the opportunity to fly the company's cutting-edge jets. This single decision underscores a key point across the CEOs in this audiobook. As a group, they were, at their core, rational and pragmatic, agnostic and clear-eyed. They did not have ideology. When offered the right price, Anders might not have sold his mother, but he didn't hesitate to sell his favorite business unit. These sales were unprecedented in the industry and highly controversial, particularly within the Pentagon. Anders's distinguished military career, however, gave him unique credibility in Washington, which allowed him to pursue this radical course of action. As longtime defense analyst Peter Aseridis put it to me, it was a little like Nixon, the longtime anti-communist, opening relations with China. No one else could have done it. Collectively, these divestitures generated an additional $2.5 billion in cash and left General Dynamics with two businesses in which it held dominant market positions: tanks and submarines. As the cash from asset sales and improved operations poured in, Anders shifted his focus to capital allocation. With prices high, he chose not to make additional acquisitions. Instead, he decided to return the majority of the company's cash to shareholders. For advice on how to do this in the most efficient manner, he turned to Harvey Kapnick. Kapnick, the former chairman of accounting giant Arthur Andersen, was a lawyer by training and had deep knowledge of the tax code. He had made his reputation with an enormously successful turnaround at Chicago Pacific, a diversified conglomerate. As the cash built up at General Dynamics, he developed two creative ideas for returning the majority of it to shareholders in an extraordinarily tax-efficient manner. First, Kapnick initiated a series of 3 special dividends to shareholders, totaling just under 50% of the company's equity value. Because of the large percentage of General Dynamics' overall business that had been divested by Anders, these dividends were deemed return of capital and were, remarkably, subject to neither capital gains nor ordinary income taxes. As a next step, Anders and Kapnick announced a gigantic $1 billion tender to repurchase 30% of the company's shares. As we've seen, share repurchases are highly tax-efficient versus traditional dividends, which are taxed at both the corporate and the individual levels. It's hard to overstate how unusual these moves were. In less than 3 years, Anders had dramatically streamlined operations, sold off over half of his company, generated $5 billion in proceeds, and, rather than redeploying the cash into R&D or new acquisitions, returned most of it to shareholders, using innovative, tax-efficient techniques. Each of these moves was unprecedented in the defense industry and created enormous value for shareholders. It is very, very rare to see a public company systematically shrink itself. As Anders summarized it to me, most CEOs grade themselves on size and growth. Very few really focus on shareholder returns. It is similarly rare, outside of the CEOs in this audiobook, to see a company systematically return proceeds to shareholders in the form of special dividends or share repurchases. The combination of the two was virtually unheard of, particularly in the tradition-bound defense industry. This abrupt series of dramatic actions stunned Wall Street and led to a meteoric rise in General Dynamics' stock price. It also attracted Warren Buffett's attention. Buffett saw that under Anders's leadership, the company was divesting assets and focusing on an innovative, shareholder-friendly capital allocation strategy. And in 1992, he bought 16% of General Dynamics stock at an average price of $72 per share. Remarkably, he also gave Anders, whom he had only met once, the proxy to vote Berkshire's shares, a position that aided Anders in implementing his strategy. Anders left at the end of his planned term in July 1993, turning the reins over to Mellor. Buffett sold his shares on Anders's departure for an excellent return, a decision, however, he regrets today. Anders served as chairman for a year before retiring to a remote island in the Northwest. He believed in the naval succession model, in which retiring captains avoid returning to their ships so as not to interfere with their successor's authority, and proudly told me that he had spoken only once to Mellor's successor, Nick Chabraya, since 1997. Jim Mellor had also trained as an engineer and worked at Hughes Aircraft and Litton Industries before joining General Dynamics in 1981. He eventually ran the shipbuilding division, where he helped the company solidify its dominant market position and where he quickly came to Anders' attention as a kindred spirit and potential lieutenant and successor. As CEO after Anders' departure, Mellor continued to focus on optimizing operations and selling the last small non-core divisions, including the Space Systems unit. In 1995, however, he went on the offensive with the $400 million acquisition of Bath Iron Works, one of the largest domestic builders of Navy ships. This acquisition had enormous symbolic value, signaling to employees and the Pentagon that the company was now ready to grow again. As Mellor said, the Bath acquisition put an end to rumors the company would be completely liquidated. In 1997, Mellor hit retirement age and passed the baton to Nick Chabraya. Chabraya had graduated from Northwestern Law School and practiced corporate law for nearly 20 years with Jenner & Block, a top Chicago law firm. He worked with General Dynamics during the troubles of the 1980s, and by the time of Anders' arrival, had become a key advisor to the company. Anders quickly realized his potential, calling him the most effective, businesslike lawyer I've ever seen. In 1993, Chabraya joined the company as general counsel and senior vice president, with the implicit understanding that he would become Mellor's successor. Chabraya set ambitious goals for himself when he became CEO. Specifically, he wanted to quadruple the company's stock price over his first 10 years as CEO, a 15% compound rate of return. He looked back into S&P records and found that this was an appropriately difficult target. Fewer than 5% of all Fortune 500 companies had achieved that benchmark in the prior 10-year period. Chabraya looked coolly at the company's prospects for the next 10 years and concluded that he could get about two-thirds of the way there through market growth and improved operating margins. The rest would need to come from acquisitions, a notable departure from Anders' strategic framework. Chabraya's approach to acquisitions was distinctive, focusing initially on small purchases around existing business lines, a new capital allocation focus for the company. As he said, "Our strategy has been to aggressively pursue targets directly related to our core businesses, broadening our product line into adjacent spaces." In his first year, he bought 12 small companies. Ray Lewis described this approach as just a piece at a time in markets we understood well. These add-on acquisitions were highly accretive and eventually led the company into the fast-growing military information technology market, which would become the company's largest business unit by 2008. Furthermore, through Chabraya's acquisition efforts, the company's tank division was able to successfully launch the Stryker attack vehicle, and the Marine Group, long a leader in submarine construction, began to build more surface ships. The crowning achievement of the Chabraya era, however, was the massive 1999 acquisition of Gulfstream, the world's largest commercial jet manufacturer. This purchase was a $5 billion bet-the-company transaction, equal to a remarkable 56% of General Dynamics' enterprise value. The deal was widely criticized at the time for its seemingly high price and its apparent divergence from Anders' focus only on defense businesses strategy. It was not, however, as radical a departure as it appeared. Gulfstream was the unquestioned leader in commercial aviation, a market with excellent long-term growth trends. It had been run for 5 years by private equity firm Forstmann Little, and investment in new product development had lagged. General Dynamics had deep experience in managing both commercial and military aircraft operations from its years owning Cessna and building planes for the Air Force, and Chabraya believed he would be able to tap this latent expertise to grow Gulfstream significantly. He also believed that commercial aviation would provide valuable diversification against fluctuations in defense spending. The returns since that time have justified his logic. Over the last couple of years, as defense spending has slowed, Gulfstream's growing operations have provided General Dynamics with substantial insulation from the vagaries of the defense spending cycle. It's important to acknowledge here the more general point that circumstances vary, and it's how you play the hand you're dealt that ultimately determines your success as an executive. Although Chabraya and Anders shared a rational, shareholder-oriented mindset, their specific actions varied with their respective circumstances, and different moves, acquisitions during Chabraya's tenure, divestitures during Anders's, made sense at different times during their tenures, although both shared an enthusiasm for stock repurchases. By the time Chabrias stepped down as CEO in mid-2008, he had, remarkably, exceeded his initial ambitious return objectives. Which brings us to the key question. What exactly do the overall returns look like for this CEO troika? How do they stack up against their peers and the lofty Welch standard? Over the 17-and-a-half-year span, from Anders' arrival in January 1991 through Chabrias' departure in July 2008, Anders and his two hand-picked successors produced the phenomenal results that can be seen in Figure 3.1, generating a remarkable 23.3% compound annual return for General Dynamics shareholders, compared with 8.9% for the S&P 500 and 17.6% for the company's peers. A dollar invested when Anders took the helm would have been worth $30 17 years later. That same dollar would have been worth $17 if invested in an index of peer companies and $6 if invested in the S&P. This CEO triad exceeded the Welch standard with a 6.7 times outperformance of the S&P and an exceptional 1.8 times outperformance of its peers. Today, General Dynamics looks very different than when Anders left the helm, yet his fundamental principles remain intact. General Dynamics is the unquestioned market leader in each of its business lines, with the industry's highest margins and return on assets and an impregnable balance sheet. In late 2007, Chabrias designated his successor, Jay Johnson. Johnson had an impressive resume. He had been the youngest ever chief of naval operations and the CEO of electric utility giant Dominion Virginia Power prior to becoming vice chairman at General Dynamics and heir designate. He has stepped, however, into very large shoes, and it will be up to him to maintain the company's extraordinary record in the uncertain years ahead. Meanwhile, Bill Anders has settled into a typically active retirement on a remote island in the San Juans. He founded a well-regarded aviation museum outside Seattle, and, well into his 70s, still flies jets. Although he has kept his distance from the company, he still holds the stock. The nuts and bolts. The key to these phenomenal returns was the company's highly effective, if unusual by defense industry standards, approach to allocating its human and capital resources. In the area of operations, Anders and his successors focused on two primary priorities: decentralizing the organization and aligning management compensation with shareholders' interests. Not surprisingly, given the military background of many of its CEOs, the defense industry has traditionally been characterized by centralized, bureaucratic organizational structures. General Dynamics, however, under Anders and his two successors, pursued a very different organizational strategy. In the early 1990s, as they tightened operations and dramatically reduced headquarters staff, Anders and Mellor began to actively promote decentralization and push responsibility further down into the organization, eliminating layers of middle management. This move to decentralization would be continued and significantly extended by Chabrias. By the end of Chabrias' tenure, the company would have more employees than when Anders arrived, but only a quarter as many people at corporate headquarters. There would be only 2 people between the CEO and the head of any profit center, whereas before there had been 4. All human relations, legal, and accounting personnel at headquarters were eliminated or pushed down into the operating divisions, and there was a conscious effort to keep staff involvement in the divisions to a minimum, to prevent headquarters from screwing around with operating people, as Chabrias says. Operating managers were held responsible, in Chabrias' words, severely accountable, for hitting their budgets and were left alone if they did so. Starting with Anders, the company also began to emphasize performance-based compensation. In the early 1990s, Anders knew he would need to offer significant compensation upside to attract new managers to General Dynamics. He would have preferred to establish a traditional stock option program, but was told by the board that shareholders, disgruntled by the stock's weak performance in the years prior to his arrival, would not approve one. Anders, however, wanted to align managers with shareholders and developed a compensation plan that rewarded managers for sustained improvements in stock price. The problem with this plan was that almost immediately after its implementation, the stock price moved quickly upward as Wall Street began to understand the effect of Anders' unusual moves, resulting in very early and large bonus payments to management. These payments were immediately seized on by the press and became highly controversial. The company, however, remained committed to performance-based compensation, and today, bonus payments and option grants remain key components of executive pay at General Dynamics. Under Anders and his successors, the company's approach to raising and allocating capital was highly differentiated from that of its defense industry peers. With the enormous proceeds from Anders's early divestitures and consistent, healthy operating cash flows, General Dynamics did not need to employ significant financial leverage, or, with one very large exception, issue equity. That exception, however, helps make an important point about capital allocation. The central event of Chebraya's tenure was the Gulfstream acquisition. So, how exactly did he pay for this massive deal? His approach was opportunistic and unusual. In a radical departure from the Anders playbook, Chebraya sold stock. A lot of stock. This was a seemingly dilutive move. Closer examination, however, reveals its sophistication and kinship with Anders's principles. The equity offering coincided with an all-time high trading multiple for General Dynamics stock, not unlike Buffett's large purchase of Gen Re, also done with a stock currency then trading at a record premium. As Chebraya described it to me, what drove me was the realization that the stock was trading at a significant premium to our historic norm, 23 times next year's projected earnings versus an historic average of 16 times. So what do you do with a high-priced stock? Use it to acquire a premium asset in a related field at a lower multiple and benefit from the arbitrage. As Ray Lewis summarized, Nick sold shares equaling 1/3 of the company to acquire a business that provided half of our consolidated operating cash flow. As with Anders's sale of the company's F-16 business, Chebraya's equity sale underscores the important point that the best capital allocators are practical, opportunistic, and flexible. They are not bound by ideology or strategy. In 1999, Chebraya saw a unique opportunity to grow and diversify his company by utilizing a uniquely inexpensive currency, and he grabbed it, adding significant economic value for his shareholders. So, what exactly did this troika do with all the cash? When it came to capital allocation, Anders and his successors made consistently, often radically, different decisions than their largest peers. At a time when his peers were on an acquisition binge, Anders, as we've seen, was an active seller. He made no acquisitions, spent very little on capital expenditures, and made savvy use of dividends and share repurchases, both of which were new to the industry. After Anders's extended shrinking exercise, Mellor's major contribution in the allocation arena was to reopen the door to acquisitions with the sizable 1995 Bath transaction, while continuing Anders's parsimonious approach to dividends and capital expenditures. Like Anders, Chebraya also pursued an idiosyncratic allocation strategy, spending meaningfully less money on capital expenditures and paying lower dividends than his peers, while devoting substantial resources to acquisitions and sporadic stock repurchases. The returns from these repurchases were excellent, averaging 17% over the entire period. All three CEOs were committed to buybacks, with Anders and Chebraya the most active in this important area. As we've seen, Anders's contribution in this area, with help from Kapnick, was the 1992 tender offer in which 30% of the company's shares were repurchased. Interestingly, Chebraya was also an aggressive repurchaser of General Dynamics stock. Belying his legal background, he thought like an investor, continually comparing the price of General Dynamics stock with its intrinsic value and acting aggressively when he saw discrepancies. As Ray Lewis said of the Chebraya era, "We bought heavily when we thought we could take advantage of market mistakes in pricing our stock." Anders and Chebraya had similar, curmudgeonly personalities. Both were feistily iconoclastic, and neither suffered fools gladly, an attitude that was by no means atypical within the broader outsider CEO group. They handled themselves with Wall Street analysts in much the same manner that football coach Bill Parcells handles reporters, with an overall demeanor that often bordered on disdain. They simply did not see the value in courting analysts, and while Wall Street may not have entirely appreciated their prickliness, General Dynamics shareholders certainly did. Postscript: the sincerest form of flattery. If imitation is the sincerest form of flattery, then General Dynamics recently received a major compliment from Northrop Grumman, one of the largest companies in the defense industry and a leading maker of fighter planes and missile systems. The company's stock market returns since the early 1990s have trailed General Dynamics by a wide margin. In 2009, a new CEO, Wes Bush, took over and announced a dramatic strategy shift that featured the sale of non-core assets, a new emphasis on return on equity and share repurchases, and a significant reduction in corporate headcount. Sound familiar? As one Wall Street analyst said, the steps being taken at Northrop Grumman are reminiscent of the changes taken by General Dynamics in the early 1990s and are at odds with the typical behavior of defense companies, which have historically tended to overemphasize revenue growth. General Dynamics has dramatically outperformed other defense companies who continued to pursue scale over the last 20 years. Since Bush's announcement of this new strategy and the first signs of its implementation, Northrop's stock has risen dramatically. Today, in a very different foreign policy climate, the Anders formula remains every bit as effective and robust as it was when the wall first came down. Chapter 4. Value Creation in a Fast-Moving Stream. John Malone and TCI. They haven't repealed the laws of arithmetic. Yet, anyway. John Malone. Luck is the residue of design. Branch Rickey. By 1970, John Malone had been at McKinsey long enough to know an attractive industry when he saw one, and the more Malone learned about the cable television business, the more he liked it. Three things in particular caught his attention: the highly predictable, utility-like revenues, the favorable tax characteristics, and the fact that it was growing like a weed. In his years at McKinsey, Malone had never before seen these characteristics in combination, and he quickly concluded that he wanted to build his career in cable. The combination of high growth and predictability, in particular, was very attractive. During the 1960s and into the early 1970s, the cable industry exhibited very rapid growth, with subscriber counts growing over 20-fold, as rural communities across the country sought better reception of television signals for their favorite channels and programs. Cable television customers paid monthly and rarely disconnected, making the business highly quantifiable and allowing experienced executives to forecast customer growth and profitability with remarkable precision. This was a near-perfect fit with Malone's background, which was unusually quantitative. To paraphrase Norman Mailer, it was a case of Superman coming to supermarket. Malone was born in 1941 in Milford, Connecticut. His father was a research engineer and his mother a former teacher. Malone idolized his father, who traveled 5 days a week visiting plants for General Electric. As a teenager, he exhibited early mechanical ability and made pocket money buying, refurbishing, and selling used radios. He was athletic and competed in fencing, soccer, and track in high school. He graduated from Yale with a combined degree in economics and electrical engineering and almost immediately married his high school sweetheart, Leslie. After Yale, Malone earned master's and PhD degrees in operations research at Johns Hopkins. His two academic fields, engineering and operations, were highly quantitative and shared a focus on optimization, on minimizing noise and maximizing output. Indeed, Malone's entire future career can be thought of as an extended exercise in hyper-efficient value engineering, in maximizing output in the form of shareholder value and minimizing noise from other sources, including taxes, overhead, and regulations. After earning his PhD, Malone took a job at Bell Labs, the highly prestigious research arm of AT&T. There, he focused on studying optimal strategies in monopoly markets. After extensive financial modeling, he concluded that AT&T should increase its debt level and aggressively reduce its equity base through share repurchases. This unorthodox advice was graciously received by AT&T's board and promptly ignored. After a couple of years, Malone concluded that AT&T's bureaucratic culture was not for him, and he took a job with McKinsey Consulting. Having promised his wife that he would not duplicate his father's travel schedule, he soon found himself on the road 4 days a week, working for a variety of Fortune 500 companies. In 1970, when one of those clients, General Instrument, offered him the opportunity to run Gerald, its rapidly growing cable television equipment division, he leapt at the opportunity. He was 29 years old. At Gerald, Malone actively cultivated relationships with the major cable companies, and after 2 years he was simultaneously courted by two of the largest operators, Steve Ross of Warner Communications and Bob Magnus of Telecommunications Inc., TCI. Despite a salary that was 60% lower than Ross's offer, he chose TCI because Magnus offered him a larger equity opportunity and because his wife preferred the relative calm of Denver to the frenetic pace of Manhattan. The company Malone decided to join had a long history of aggressive growth and would soon be flirting with bankruptcy. Bob Magnus had founded TCI in 1956, mortgaging his home to pay for his first cable system in Memphis, Texas. Magnus, a peripatetic cottonseed salesman and rancher, had learned about the cable television business while hitchhiking, and like Malone 15 years later, had immediately recognized its compelling economic characteristics. Magnus was particularly quick to grasp the industry's favorable tax characteristics. Prudent cable operators could successfully shelter their cash flow from taxes by using debt to build new systems and by aggressively depreciating the cost of construction. These substantial depreciation charges reduced taxable income, as did the interest expense on the debt, with the result that well-run cable companies rarely showed net income, and as a result, rarely paid taxes, despite very healthy cash flows. If an operator then used debt to buy or build additional systems and depreciated the newly acquired assets, he could continue to shelter his cash flow indefinitely. Magnus was among the first to fully recognize these attributes and make aggressive use of leverage to build his company, famously saying that it was better to pay interest than taxes. TCI went public in 1970, and by 1973, when Malone joined, had become the fourth largest cable company in the country, with 600,000 subscribers. Its debt at that time was equal to an astonishing 17 times revenues. Magnus had realized that he needed additional management talent to shepherd the company through the next phase of its growth, and after an extended courtship, had landed the McKinsey wunderkind. Malone brought an unusual combination of talents to TCI, including exceptional analytical ability, financial sophistication, technical savvy, and boldness. His tenure, however, got off to a rocky start. In late 1972, the market for cable stocks was hot, and TCI planned an additional public offering to pay down a portion of its extraordinary debt load. Within months of Malone's arrival, however, the industry was blindsided by new regulations, and the market for cable stocks cooled, forcing the company to pull its offering and leaving it with an unsustainable debt position. The sudden evaporation of liquidity that resulted from the 1973-1974 Arab oil embargo left the entire industry in a precarious position. TCI, however, with its new 32-year-old CEO, was burdened with significantly more debt than any of its peers and teetered on the edge of bankruptcy. Lower than whale dung is Malone's typically blunt assessment of his starting point at TCI. Malone had been dealt a tough hand, and he and Magnus spent the next several years keeping the lenders at bay and the company out of bankruptcy. They met constantly with bankers. At one point in a particularly tense lender meeting, Malone threw his keys on the conference room table and walked out of the room, saying, "If you want the systems, they're yours." The panicked bankers eventually relented and agreed to amend the terms on TCI's loans. During this period, Malone introduced a new financial and operating discipline to the company, telling his managers that if they could grow subscribers by 10% per year while maintaining margins, he would ensure that they stayed independent. A frugal, entrepreneurial culture emerged from these years and pervaded the company, extending from corporate headquarters down into field operations. TCI's headquarters did not look like the headquarters of the largest company in an industry that was redefining the American media landscape. The company's offices were Spartan, with few executives at corporate, fewer secretaries, and peeling metal desks on Formica floors. The company had a single receptionist, and an automated service answered the phone. TCI executives stayed together on the road, usually in motels. COO J.C. Sparkman recalls, "Holiday Inns were a rare luxury for us in those days." Malone saw himself as an investor and capital allocator, delegating responsibility for day-to-day operations to Sparkman, his longtime lieutenant, who managed the company's far-flung operations through a rigorous budgeting process. Managers were expected to hit their cash flow budget, and these targets were enforced with an almost military discipline by Sparkman, a former Air Force officer. Managers in the field had a high degree of autonomy as long as they hit their numbers. System managers who missed monthly budgets were frequently visited by the itinerant COO, and underperformers were quickly weeded out. The edifice complex. There is an apparent inverse correlation between the construction of elaborate new headquarters buildings and investor returns. As an example, over the last 10 years, 3 media companies, the New York Times Company, IAC, and Time Warner, have all constructed elaborate Taj Mahal-like headquarters towers in Midtown Manhattan at great expense. Over that period, none of these companies has made significant share repurchases or had market-beating returns. In contrast, not one of the outsider CEOs built lavish headquarters. As a result of this frugality, TCI for a long time had the highest margins in the industry and gained a reputation with its investors and lenders as a company that consistently underpromised and over-delivered. In paging through analyst reports from early in the company's history, one can see a consistent recurring pattern of slightly higher than projected cash flow and subscriber numbers quarter after quarter. By 1977, TCI had finally grown to the point that it was able to entice a consortium of insurance companies to replace banks with lower-cost debt. With his balance sheet stabilized, Malone was finally able to go on the offensive and implement his strategy for TCI, which was highly unconventional and stemmed from a central strategic insight that had been germinating since he joined the company. Malone, the engineer and optimizer, realized early on that the key to creating value in the cable television business was to maximize both financial leverage and leverage with suppliers, particularly programmers, and that the key to both kinds of leverage was size. This was a simple and deceptively powerful insight, and Malone pursued it with single-minded tenacity. As he told longtime TCI investor David Wargo in 1982, "The key to future profitability and success in the cable business will be the ability to control programming costs through the leverage of size." In a cable television system, the largest category of cost, 40% of total operating expenses, is the fees paid to programmers, HBO, MTV, ESPN, etc. Larger cable operators are able to negotiate lower programming costs per subscriber, and the more subscribers a cable company has, the lower its programming cost, and the higher its cash flow per subscriber. These discounts continue to grow with size, providing powerful scale advantages for the largest players. Thus, the largest player with the lowest programming costs would have a sustainable advantage in making new acquisitions versus smaller players. They would be able to pay more for a cable company and still earn the same or better returns, thereby creating a virtuous cycle of scale that went something like this. If you buy more systems, you lower your programming costs and increase your cash flow, which allows more financial leverage, which can then be used to buy more systems, which further improves your programming costs, and so on ad infinitum. The logic and power of this feedback loop now seems obvious, but no one else at the time pursued scale remotely as aggressively as Malone and TCI. Related to this central idea was Malone's realization that maximizing earnings per share, EPS, the holy grail for most public companies at that time, was inconsistent with the pursuit of scale in the nascent cable television industry. To Malone, higher net income meant higher taxes, and he believed that the best strategy for a cable company was to use all available tools to minimize reported earnings and taxes, and fund internal growth and acquisitions with pre-tax cash flow. It's hard to overstate the unconventionality of this approach. At the time, Wall Street evaluated companies on EPS, period. For a long time, Malone was alone in this approach within the cable industry. Other large cable companies initially ran their companies for EPS, only later switching over to a cash flow focus. Comcast finally switched in the mid-1980s, once they realized the difficulty of showing EPS while growing a cable business. As longtime cable analyst Dennis Leibowitz told me, ignoring EPS gave TCI an important early competitive advantage versus other public companies. While this strategy now seems obvious and was eventually copied by Malone's public peers, at the time Wall Street did not know what to make of it. In lieu of EPS, Malone emphasized cash flow to lenders and investors, and in the process invented a new vocabulary, one that today's managers and investors take for granted: Terms and concepts such as EBITDA, earnings before interest, taxes, depreciation, and amortization, were first introduced into the business lexicon by Malone. EBITDA in particular was a radically new concept, going further up the income statement than anyone had gone before to arrive at a pure definition of the cash-generating ability of a business before interest payments, taxes, and depreciation or amortization charges. Today, EBITDA is used throughout the business world, particularly in the private equity and investment banking industries. The market for cable stocks remained volatile throughout the 1970s and into the early 1980s. Malone and Magnus, concerned about the potential for a hostile takeover, took advantage of occasional market downturns to opportunistically repurchase stock, thereby increasing their combined stake. In 1978, they created a supervoting class of B shares, and through a complex series of repurchases and trades, were able to secure what longtime executive John C. refers to as hard control of TCI by 1979, when their combined ownership of B shares reached 56%. From this point forward, with control and a healthier balance sheet, Malone focused on achieving scale with a unique combination of relentlessness and creativity. Using the debt available from the company's new lenders, internal cash flow, and the occasional equity offering, Malone began an extraordinarily active acquisition program. Between 1973 and 1989, the company closed 482 acquisitions, an average of one every other week. To Malone, a subscriber was a subscriber was a subscriber. As longtime investor Rick Reese said, in the pursuit of scale, he was willing to look at beachfront property even if it was near a toxic waste dump. And over the years, he bought systems from sellers as diverse as the Teamsters and Lady Bird Johnson. He did not, however, buy indiscriminately. In the late 1970s and early 1980s, the industry entered a new phase with the advent of satellite-delivered channels, such as HBO and MTV. Cable television suddenly went from a service primarily targeting rural customers with poor reception to one delivering highly desirable new channels to content-starved urban markets. As the industry entered this new stage, many of the larger cable companies began to focus on competing for large metropolitan franchises, and the bidding for these franchises quickly became heated and expensive. Malone, however, unlike his peers, was uncomfortable with the extraordinary economic terms that municipalities were extracting from pliant cable operators. And alone among the larger cable companies, he refrained from these franchise wars, focusing instead on acquiring less expensive rural and suburban subscribers. By 1982, TCI was the largest company in the industry, with 2.5 million subscribers. When many of the early urban franchises collapsed under a combination of too much debt and uneconomic terms, Malone stepped forward and acquired control at a fraction of the original cost. In this manner, the company gained control of the cable franchises for Pittsburgh, Chicago, Washington, St. Louis, and Buffalo. Throughout the 1980s, aided by a very favorable mid-decade relaxation of FCC regulations, TCI continued to buy systems at an aggressive clip, mixing in occasional larger deals, Westinghouse and Storer Communications, with a steady stream of small transactions. In addition, the company continued to actively grow its portfolio of joint ventures, partnering with legendary cable entrepreneurs such as Bill Bresnan, Bob Rosencrans, and Leo Hendry to create cable companies in which TCI owned minority stakes. By 1987, the company was twice the size of its next largest competitor, Time Inc.'s ATC. Malone's creativity further evidenced itself in a wave of joint ventures in the late 1970s and early 1980s, in which he partnered with promising young programmers and cable entrepreneurs. A partial list of these partners reads like a Cable Hall of Fame roster, including such names as Ted Turner, John C., John Hendricks, and Bob Johnson. In putting these partnerships together, Malone was, in effect, an extremely creative venture capitalist who actively sought young, talented entrepreneurs and provided them with access to TCI's scale advantages, its subscribers and programming discounts, in return for minority stakes in their businesses. In this way, he generated enormous returns for his shareholders. When he saw an entrepreneur or an idea that he liked, he was prepared to act quickly. beginning in 1979, when he famously wrote Bob Johnson, the founder of Black Entertainment Television, BET, a $500,000 check at the end of their first meeting. Malone began to actively pursue ownership stakes in programming entities, offering in return a potent combination of startup capital and access to TCI's millions of households. Malone led a consortium of cable companies in the bailout of Ted Turner's Turner Broadcasting System, whose channels included CNN and the Cartoon Network, when it flirted with bankruptcy in 1987. And by the end of the 1980s, TCI's programming portfolio would include Discovery, Encore, QVC, and BET, in addition to the Turner channels. He was now a significant owner of both cable systems and cable programming. The early 1990s produced an almost perfect storm of bad news for the cable industry, with the combined impact of new highly leveraged transaction, HLT, legislation in 1990 limiting the industry's access to debt capital, and, more significantly, the FCC's tightening of cable regulations in 1993, which rolled back cable rates. Despite these negative developments, Malone continued to selectively acquire large cable systems, Viacom and United Artists Cable, and launch new programming networks, including Starz Encore and a series of regional sports networks in partnership with Rupert Murdoch and Fox. In 1993, in a stunning development, Malone reached an agreement to sell TCI to phone giant Bell Atlantic for $34 billion in stock. The deal was called off, however, as re-regulation hit and TCI's cash flow and stock price fell. As the decade progressed, Malone spent more time on projects outside of the core cable business. He led a consortium of cable companies in the creation of two sizable new entities, Teleport, a competitive telephone service, and Sprint PCS, a joint venture with Sprint to bid on cellular franchises. In pursuing these new initiatives, Malone was allocating the firm's capital and his own time to projects that he believed leveraged the company's dominant market position and offered compelling potential returns. In 1991, he spun off TCI's minority interests in programming assets into a new entity, Liberty Media, in which he ended up owning a significant personal stake. This was the first in a series of tracking stocks that Malone created, including TCI Ventures, for Teleport, Sprint PCS, and other non-cable assets, and TCI International, for TCI's ownership in miscellaneous foreign cable assets. Malone was a pioneer in the use of spin-offs and tracking stocks, which he believed accomplished two important objectives. One, increased transparency, allowing investors to value parts of the company that had previously been obscured by TCI's Byzantine structure, and two, increased separation between TCI's core cable business and other related interests, particularly programming, that might attract regulatory scrutiny. Malone started with the spin-off of the Western Telecommunications microwave business in 1981, and by the time of the sale to AT&T, the company had spun off a remarkable 14 different entities to shareholders. In utilizing these spin-offs, Malone, like Henry Singleton and Bill Sturritz, was consciously increasing the complexity of his business in pursuit of the best economic outcome for shareholders. After Sparkman retired in 1995, Malone delegated authority for the company's cable operations to a new management team led by Brendan Clouston, a former marketing executive. Under Clouston, TCI began to centralize customer service and spend aggressively to upgrade its aging cable facilities. In the third quarter of 1996, however, TCI badly missed its forecast, losing subscribers for the first time in its history and showing a decline in quarterly cash flow. Malone, disappointed by these results, reassumed the helm and, uncharacteristically, took direct management control of operations, quickly reducing employee headcount by 2,500, halting all orders for capital equipment, and aggressively renegotiating programming contracts. He also fired the consultants who had been hired to help with the system upgrade and returned responsibility for customer service to the local system managers. As operations stabilized and cash flow improved, he brought on Leo Hendry, the CEO of Intermedia Partners, a large TCI joint venture, to run operations, and returned his attention to strategic projects. Hendry continued the restructuring process, bringing back TCI veteran Marvin Jones as his COO, giving more responsibility to regional managers, and actively pursuing trades to more tightly cluster subscribers and reduce costs. Once Hendry was on board, Malone focused his attention on developing digital set-top boxes that would allow the industry to compete effectively with the new satellite television providers. He courted Microsoft, but eventually struck a deal with General Instrument, the industry's largest equipment manufacturer, for 10 million set-top boxes at $300 each. In return, he asked for a significant equity stake in the company, eventually owning 16%. In the middle of the operational crisis of 1996 and 1997, Bob Magnus, Malone's mentor and longtime partner, died, throwing control of the company into question. Through a series of typically complex transactions, Malone was able, along with the company, to purchase Magnus's supervoting shares, ensuring retention of hard control for the endgame phase at TCI. In the late 1990s, several of Malone's strategic non-cable projects began to bear significant fruit. He had been correct about their return potential. In 1997, Teleport was sold to AT&T for an astounding $11 billion, a 28-fold return on investment. In 1998, the Sprint PCS joint venture was sold to Sprint Corporation for $9 billion in Sprint stock, and in 1999, General Instrument was sold to Motorola for $11 billion. In the late 1990s, Malone shifted his attention to finding a home for TCI. Although Malone loved the cable business, he was a purely rational executive and, as early as 1981, had told analyst David Wargo, "I felt TCI might be worth $48 a share and would sell if someone offered us this." This target price continued to grow, and for a long time no one was willing to pay it. As the 1990s progressed, however, Malone saw a combination of factors clouding TCI's future: rising competition from satellite television, the enormous cost of upgrading the company's rural systems, and uncertainty about management succession. When he received an inquiry from AT&T's aggressive new CEO, Mike Armstrong, he eagerly initiated discussions. Characteristically, he handled the negotiations himself, often facing a sizable crowd of AT&T lawyers, bankers, and accountants across the table. As talks between the two companies unfolded, Malone proved to be as adept at selling as he had been at acquiring. As Rick Reese said, "He turned the board of AT&T upside down, shook every nickel from their pockets, and returned them to their board seats." The financial terms, 12 times EBITDA, $2,600 per subscriber, were extraordinary, and, remarkably, the company received no discount for its patchwork quilt of decrepit rural systems. Not surprisingly, Malone, ever watchful of unnecessary taxes, structured the transaction as a stock deal, allowing his investors to defer capital gains taxes. In addition, Malone retained effective control of the Liberty Programming subsidiary with 6 of 9 board seats and secured an attractive, long-term carriage deal for Liberty's channels on AT&T's cable systems. This transaction was the final resounding validation of Malone's unique strategy at TCI, producing exceptional returns for his investors. Mind-boggling returns, in fact. In the 25 years after Malone took the helm at TCI, the entire cable industry grew enormously, and all the public companies in it prospered. No cable executive, however, created remotely as much value for shareholders as Malone. From his debut in 1973 until 1998, when the company was sold to AT&T, the compound return to TCI's shareholders was a phenomenal 30.3%, compared with 20.4% for the other publicly traded cable companies and 14.3% for the S&P 500 over the same period. A dollar invested with TCI at the beginning of the Malone era was worth over $900 by mid-1998. That same dollar was worth $180 if invested in the other publicly traded cable companies and $22 if invested in the S&P 500. Thus, TCI outperformed the S&P by over 40-fold and its public peers by 5-fold during Malone's tenure. The nuts and bolts. The cable television business during Malone's tenure was extremely capital-intensive, with enormous amounts of cash required to build, buy, and maintain cable systems. As Malone sought to achieve scale by growing his subscriber base, 3 primary sources of capital were available to him in addition to TCI's robust operating cash flow: debt, equity, and asset sales. His use of each of these sources was distinctive. Malone pioneered the active use of debt in the cable industry. He believed financial leverage had two important attributes. It magnified financial returns, and it helped shelter TCI's cash flow from taxes through the deductibility of interest payments. Malone targeted a ratio of 5 times debt to EBITDA and maintained it throughout most of the 1980s and 1990s. Scale allowed TCI to minimize its cost of debt, and Malone, having survived the harrowing experience of the mid-1970s, structured his debt with great care to lower costs and avoid cross-collateralization, so that if one system defaulted on its debt, it would not affect the credit of the entire company. This compartmentalization into bulkheads, the term derived from Malone's fascination with all things nautical, he also sometimes referred to TCI's bow wave of depreciation, caused further complexity in TCI's structure, but provided the company with substantial downside protection. When it came to issuing equity, Malone was parsimonious, with the company's occasional offerings timed to coincide with record-high multiples on his stock. As Malone said in a 1980 interview, "Our recent rise in stock price provided us with a good opportunity for this offering." He was justifiably proud of his stinginess in issuing equity and believed it was another factor that distinguished him from his peers. Malone occasionally and opportunistically sold assets. He coolly evaluated the public and private values for cable systems and traded actively in both markets when he saw discrepancies. Malone carefully managed the company's supply of net operating losses, NOLs, accumulated over years of depreciation and interest deductions, which allowed him to sell assets without paying taxes. As a result of this tax shield, he was comfortable selling systems if prices were attractive, to raise capital to fund future growth. As Malone told David Wargo as early as 1981, "It makes sense to maybe sell off some of our systems. At 10 times cash flow to buy back our stock at 7 times. Another key source of capital at the company was taxes not paid. As we've seen, tax minimization was a central component of Malone's strategy at TCI, and he took Magnus's historical approach to taxes to an entirely new level. Malone abhorred taxes. They offended his libertarian sensibilities, and he applied his engineering mindset to the problem of minimizing the leakage from taxes as he might have minimized signal leakage on an electrical engineering exam. As the company grew its cash flow by 20-fold over Malone's tenure, it never paid significant taxes. In fact, Malone's one extravagance in terms of corporate staff was in-house tax experts. The internal tax team met monthly to determine optimal tax strategies, with meetings chaired by Malone himself. When he sold assets, he almost always sold for stock. The reason that, to this day, Liberty has large holdings of News Corp, Time Warner, Sprint, and Motorola stock, or sheltered gains through accumulated NOLs, and he made constant use of the latest tax strategies. As Dennis Leibowitz said, TCI hardly ever disposed of an asset unless there was a tax angle to it. No other cable company devoted remotely as much time and attention to this area as TCI. Given the extraordinary growth in cable during the 1970s and 1980s, Malone had the luxury of high-return capital allocation options, and he structured TCI to optimize across them. As one might expect from his background, Malone had a coolly rational, almost surgical approach to capital allocation, and he was willing to look at any investment project that offered attractive returns regardless of complexity or unconventionality. Applying his engineering mindset, Malone looked for no-brainers, focusing only on projects that had compelling returns. Interestingly, he didn't use spreadsheets, preferring instead projects where returns could be justified by simple math. As he once said, "Computers require an immense amount of detail. I'm a mathematician, not a programmer. I may be accurate, but I'm not precise." In deciding how to deploy TCI's capital, Malone made choices that were starkly different from those of his peers. He never paid dividends, or even considered them, and rarely paid down debt. He was parsimonious with capital expenditures, aggressive in regard to acquisitions, and opportunistic with stock repurchases. Until the advent of satellite competition in the mid-1990s, Malone saw no quantifiable benefit to improving his cable infrastructure unless it resulted in new revenues. To him, the math was undeniably clear. If capital expenditures were lower, cash flow would be higher. As a result, For years, Malone steadfastly refused to upgrade his rural systems, despite pleas from Wall Street. As he once said in a typically candid aside, "These rural systems are our dregs, and we will not attempt to rebuild them." This attitude was very different from that of the leaders of other cable companies who regularly trumpeted their extensive investments in new technologies. Ironically, this most technically savvy of cable CEOs was typically the last to implement new technology, preferring the role of technological settler to that of pioneer. Malone appreciated how difficult and expensive it was to implement new technologies, and preferred to wait and let his peers prove the economic viability of new services, saying of an early 1980s decision to delay the introduction of a new set-top box, "We lost no major ground by waiting to invest. Unfortunately, pioneers in cable technology often have arrows in their backs." TCI was the last public company to introduce pay-per-view programming, and when it did, Malone convinced the programmers to help pay for the equipment. He was, however, prepared to invest when he needed to, and he was among the first in the industry to champion expensive new set-top boxes to help increase channel capacity and customer choice when satellite competition arose in the mid-1990s. Far and away, the largest capital allocation outlet for TCI was, of course, acquisitions. As we've seen, Malone was an aggressive yet disciplined buyer of cable systems, a seeming oxymoron. He bought more companies than anybody else. In fact, he bought more companies than his 3 or 4 largest competitors combined. Collectively, these acquisitions represented an enormous bet on the future of cable, an industry long characterized by regulatory uncertainty and potential competitive threats. And from 1979 through 1998, the average annual value of TCI's acquisitions equaled a remarkable 17% of enterprise value, exceeding 20% in 5 of those years. He was also, however, a value buyer, and he quickly developed a simple rule that became the cornerstone of the company's acquisition program. Only purchase companies if the price translated into a maximum multiple of 5 times cash flow after the easily quantifiable benefits from programming discounts and overhead elimination had been realized. This analysis could be done on a single sheet of paper, or if necessary, the back of a napkin. It did not require extensive modeling or projections. What mattered was the quality of the assumptions and the ability to achieve the expected synergies, and Malone and Sparkman trained their operations teams to be highly efficient in eliminating unnecessary costs from new acquisitions. Immediately after TCI took over the floundering Pittsburgh franchise from Warner Communications, it reduced payroll by half, closed the elaborate studios the prior owners had built for the city, and moved headquarters from a downtown skyscraper to a tire warehouse. Within months, the formerly unprofitable system was generating significant cash flow. Malone's simple rule allowed him to act quickly when opportunity presented itself. When the Hoke family, owners of a 1 million-subscriber cable business, decided to sell in 1987, Malone was able to strike a deal with them in an hour. He was also comfortable walking away from transactions that did not meet the rule. Paul Kagan, a longtime industry analyst, remembered Malone walking away from a sizable Hawaiian transaction that was only $1 million over his target price. Malone, alone among the CEOs of major public cable companies, was also an opportunistic buyer of his own stock during periodic market downturns. As Dennis Leibowitz said, "None of the other public MSOs, multiple system operators, made any significant share repurchases over this period." In contrast, TCI repurchased over 40% of its shares during Malone's tenure. His timing with these purchases was excellent, producing an average compound return of over 40%. An exchange with Dave Wargo in the early 1980s was typical of Malone's opportunistic philosophy regarding buybacks. "We are evaluating all alternatives in order to buy our equity at current prices to arbitrage the differential between its current multiple and the private market value." These buybacks provided a useful benchmark in evaluating other capital allocation options, including acquisitions. As Malone said to Wargo in 1981, "With our stock in the low 20s, purchasing it looks more attractive than buying private systems." To the standard menu of 5 capital allocation alternatives, Malone added a 6th, investment in joint ventures. No CEO has ever used joint ventures as actively or created as much value for his shareholders through them as John Malone. Malone realized early on that he could leverage the company's scale into equity interests in programmers and other cable companies, and that these interests could add significant value for shareholders with very little incremental investment. At the time of the sale to AT&T, the company had 41 separate partnership interests, and much of TCI's long-term return is attributable to these cable and non-cable joint ventures. Because of these polyglot joint ventures, TCI was notoriously hard to analyze and often sold at a discount to its cable peers. As David Wargo said, "To understand the company, you had to read all of their footnotes, and very few did." Malone, however, believed this complexity was a small price to pay for the enormous value created over the years by these projects. As with many of Malone's initiatives, these joint ventures seemed logical in hindsight, but at the time they were highly unconventional. No one else in the industry used joint ventures to increase system ownership, and only later did other MSOs begin to seek ownership stakes in programmers. Despite his cool, calculating, almost Spock-like approach, Malone was also successful in creating a very strong culture and engendering great employee loyalty. He did this by providing a powerful mix of incentive and autonomy. TCI had an aggressive employee stock purchase program in which the company matched employee contributions and invited participation from all levels in the organization. Many early employees, supposedly including Malone's longtime secretary, became millionaires, and this culture bred tremendous loyalty. In Malone's first 16 years at the helm, not a single senior executive left the company. TCI's operations were remarkably decentralized, and as late as 1995, when Sparkman retired, the company had only 17 employees at corporate in a company with 12 million subscribers. As Malone put it with characteristic directness, "We don't believe in staff. Staff are people who second-guess people." The company did not have human resource executives and didn't hire a PR person until the late 1980s. TCI's culture was described by Dennis Leibowitz as a group of frugal, action-oriented cowboys who defined themselves in counterpoint to the more conservative and bureaucratic Easterners who ran the other large cable companies. Malone created a model for savvy capital allocation in rapidly growing, capital-intensive businesses that has been followed by executives in industries as diverse as cellular telephony, records management, and communications towers. Among the CEOs in this audiobook, he most resembles that other high-level mathematician and PhD, Henry Singleton. For mathematicians, insights often come when variables are taken to extremes, and Malone was no exception. Nothing about TCI was characterized by half measures. TCI was the largest company in the cable industry, with the lowest programming costs, least maintained facilities, most complex structure, and, oh yes, far and away the highest returns. His management of TCI had a quality of asceticism about it. Every element of the company's strategy, from the pursuit of scale to tax minimization to the active use of financial leverage, was designed to optimize shareholder returns. As Malone said in summing up his analytically driven approach to building TCI, "They haven't repealed the laws of arithmetic. Yet, anyway." A fact for which his shareholders are eternally grateful. Chapter 5. The Widow Takes the Helm. Katharine Graham and the Washington Post Company. Establishing and maintaining an unconventional approach requires frequently appearing downright imprudent in the eyes of conventional wisdom. David Swenson, Chief Investment Officer, Yale University Endowment. Katharine Graham's path to becoming chairman and CEO of the Washington Post Company was highly unusual. The daughter of prominent financier and Washington Post owner Eugene Meyer, she grew up in a privileged milieu of servants, boarding schools, country houses, and international travel. In 1940, she married Philip Graham, a brilliant Harvard-trained lawyer and protege of Supreme Court Justice Felix Frankfurter. Graham was tapped by Meyer in 1946 to run the company, which he would do with intermittent brilliance until his sudden death by suicide in 1963. After his tragic death, Katharine found herself thrust unexpectedly into the CEO role. It is impossible to overstate Graham's unpreparedness for this position. At age 46, she was the mother of 4 and hadn't been regularly employed since the birth of her first child nearly 20 years before. With Phil's unexpected death, she suddenly found herself the only female chief executive of a Fortune 500-size company. Naturally shy, she was understandably terrified. This story, although remarkable, is well known, the best version by far being Graham's own Pulitzer Prize-winning autobiography, Personal History, published in 1997. What's less well appreciated is what Graham did for her shareholders. From the time of the company's IPO in 1971 until she stepped down as chairman in 1993, the compound annual return to shareholders was a remarkable 22.3%, dwarfing both the S&P, 7.4%, and her peers, 12.4%. A dollar invested at the IPO was worth $89 by the time she retired, versus $5 for the S&P and $14 for her peer group. As Figure 5.1 shows, she outperformed the S&P by 18-fold and her peers by over 6-fold. She was simply the best newspaper executive in the country during this 22-year period by a very wide margin. When Graham assumed the presidency of the Washington Post Company on September 20, 1963, only 2 months before the death of her friend John F. Kennedy, she inherited a company that had grown significantly under Phil's leadership and owned a portfolio of media assets, including the Post itself, one of 3 papers in the growing D.C. market, Newsweek magazine, and 3 television stations in Florida and Texas. For the next few years, she took her time settling into her new position and familiarizing herself with the business and her board and management team. Starting in 1967, she began to make her presence felt when she made her first significant personnel decision, replacing longtime Post editor-in-chief Russ Wiggins with the brash 44-year-old Ben Bradley, a relatively unproven assistant editor at Newsweek. In 1971, on the advice of her board, she filed to take the company public in order to raise capital for acquisitions. Within a week of the offering, the newspaper became embroiled in the Pentagon Papers crisis, which presented an opportunity to publish a highly controversial and negative internal Pentagon assessment of the war in Vietnam that a court had barred the New York Times from publishing. The Nixon administration, fearing a fresh wave of negative publicity on the war, threatened to challenge the company's broadcast licenses if it published the report. Such a challenge would have scuttled the stock offering and threatened one of the company's primary profit centers. Graham, faced with unclear legal advice, had to make the decision entirely on her own. She decided to go ahead and print the story, and the Post's editorial reputation was made. The Nixon administration did not challenge the TV licenses, and the offering, which raised $16 million, was a success. In 1972, the Washington Post, with Graham's full support, began intensive investigations into the Republican campaign improprieties that would eventually mushroom into the Watergate imbroglio. Bradley and 2 young investigative reporters, Carl Bernstein and Bob Woodward, would spearhead the coverage of this extraordinary scandal, which would eventually lead to Richard Nixon's resignation in the summer of 1974. This journalistic coup secured a Pulitzer for the Post, one of a remarkable 18 during Bradley's editorship, and established it as the only journalistic peer to the New York Times. The rumblings and threats from the Nixon administration continued throughout Watergate, and Graham resolutely ignored them. Graham used a portion of the proceeds from the public offering to buy the New Jersey-based Trenton Times, which proved to be a mediocre acquisition. The Times was an afternoon paper in a competitive 2-paper market, and it struggled to grow. Graham learned a valuable lesson from this experience and would be appropriately cautious about acquisitions going forward. In 1974, a new and unknown investor began to accumulate stock in the company, eventually buying 13% of its shares. Ignoring the advice of her board, Graham met with the newcomer, Warren Buffett, and invited him to join the board. Buffett would quickly become her business mentor and would help her navigate an unorthodox course for the company. In 1975, the company faced a massive strike led by the powerful Pressmen's Union, which began when strikers set fire to the printing facility. Graham, after consulting with Buffett and the rest of her board, decided to fight the strike. After missing only 1 day of publication, she and Bradley, and her 27-year-old son, Donald, assembled a skeleton crew that managed to get the paper out for 139 consecutive days until the pressmen finally agreed to accept significant concessions. This strike was a harrowing experience for all involved. At one point, one of the picketers was spotted wearing a shirt that read, "Phil shot the wrong Graham." But these concessions dramatically improved the Post's profitability and represented a turning point for the entire industry, one of the first times a major metropolitan paper had ever broken a strike. For Graham, the strike was a personal turning point, the business equivalent of Watergate. From this point forward, there was no question who was in charge at the Washington Post Company. It was at this time, coached by Buffett, that Graham made another unconventional decision and began aggressively buying her own stock, something very few people, outside of Henry Singleton and Tom Murphy, were even thinking about at the time. Over the next several years, she would repurchase almost 40% of the company's shares at rock-bottom prices. Significantly, none of her peers at other major newspaper companies followed her lead. In 1981, two significant events occurred. First, the Post's longtime rival, the Washington Star, after years of declining circulation, finally ceased publication. This left the Post, with its lean post-strike cost structure, as the monopoly daily newspaper in the nation's capital, which led to a dramatic increase in circulation and profitability that continued throughout the decade. The second development was even more significant. After 4 previous attempts during the decade of the 1970s, Graham finally found a strong chief operating officer in Dick Simmons. Simmons, who had been the COO at Dun & Bradstreet, another diversified media company, wasted little time in rationalizing the company's operating units, which were running at lower margins than peer companies. His arrival ushered in an era of greatly increased profitability and further underscores the critical role played by strong operating lieutenants in the success of the outsider CEOs. Simmons, with Graham's support, brought in new executive talent, divested the Trenton paper, changed the compensation structure to emphasize bonus compensation, and insisted on strong performance relative to peers. Within several years, the company's newspaper and television margins had almost doubled, resulting in a surge in profitability. The 1980s represented a new high watermark for deal-making in the newspaper industry. Prices skyrocketed, as both profits and multiples rose precipitously. Alone among major newspaper company executives, Graham stood on the sidelines. The company looked closely at many deals, including large papers in Iowa, Texas, and Kentucky, but it made only 2 acquisitions, both of them small. It's important to recognize how unusual this restrained behavior was in the hothouse climate of the mid to late 1980s. It was a lonely path that elicited much commentary from Graham's peers and the press, a particularly difficult position for the only female executive in a high-profile, clubby, male-dominated industry. Importantly, most of the Post Company's acquisitions under Graham would lead it into new businesses, unrelated to newspapers or broadcasting. In 1983, after extensive research by one of Simmons's new hires, a former management consultant named Alan Spoon, the company made a successful foray into the cellular telephone business, buying franchises in 6 metropolitan markets, including Detroit, Washington, and Miami, for $29 million. In 1984, she acquired the Stanley Kaplan test preparation business, establishing a toehold in the education market. Finally, in 1986, Graham, thanks to a timely introduction by Buffett, made her largest acquisition ever, the purchase of Capital City's cable television assets for $350 million. Each of these businesses would prove enormously important for the Post Company in the years ahead. In early 1988, as values skyrocketed and Graham began to appreciate the large capital expenditures required to develop its cellular systems, she made a rare divestiture, deciding to sell the company's telephone assets for $197 million, an extraordinary return on its investment. During the recession of the early 1990s, when her over-leveraged peers were forced to the sidelines, the company became uncharacteristically acquisitive, taking advantage of dramatically lower prices to opportunistically purchase cable television systems, underperforming TV stations, and a few education businesses. When Kay Graham stepped down as chairman in 1993, the Post Company was by far the most diversified among its newspaper peers, earning almost half its revenues and profits from non-print sources. This diversification would position the company for further outperformance under her son Donald's leadership. Graham did an excellent job of managing her succession, not a given at family-controlled firms, and spent the late 1980s and early 1990s readying the next generation of leaders at the company, including Donald, who would replace her as CEO in 1991, and Alan Spoon, who would replace his mentor, Dick Simmons, as COO, also in 1991. As Graham stepped down at age 76, talented younger managers would also assume leadership roles at the company's increasingly important cable, Tom Might, and education, Jonathan Greer, divisions. Their talent and leadership would position the Post Company for another 15 years of outperformance versus its peers. The nuts and bolts. Graham, under Buffett's tutelage, proved to be a highly effective, if unorthodox, capital allocator. Her approach in this important area was characterized by industry-low levels of dividends and debt, an industry-high level of stock repurchases, relatively few acquisitions, and a careful approach to capital expenditures. We'll look now at these areas, starting with the company's sources of capital. During Graham's tenure, the Post Company generated consistently strong cash flow, with profitability improving dramatically during the decade of the 1980s as newspaper revenue spiked after the Star folded, and Dick Simmons increased margins across all the operating units. In addition to this wave of cash, the company had two other sources of capital, both of them rarely employed: leverage and asset sales. Graham was generally reticent about using debt, and during her tenure, the Post consistently maintained the most conservative balance sheet among its peers. Graham raised significant debt only a few times during her tenure, most notably to finance the 1986 purchase of the capital city's cable systems. The Post's strong cash flow, however, allowed the bulk of this debt load to be paid down in less than 3 years. Under Graham, the Post Company, like Buffett's Berkshire, very rarely sold operating businesses and actively eschewed spin-offs, preferring instead the long-term direct ownership model. The company made its lone significant exception in early 1988 when it decided to sell its cellular assets, generating an extraordinary return on investment. Graham deployed this cash with great care. Throughout her tenure, she maintained a minimal level of dividends, believing them to be tax inefficient. Again, it's worth emphasizing the contrarian nature of this approach, particularly in the newspaper industry, where founding families, some of whose members typically depended on the dividend income, usually had a high degree of ownership. The Post, under Graham, consistently paid the lowest level of dividends among its peer group and thus had the highest retained earnings. Graham's approach to deploying these earnings was influenced by Simmons, Buffett, and another director, Dan Burke of Capital Cities. All capital expenditure decisions were submitted to a rigorous approval process, which required attractive returns on invested capital. As Alan Spoon summarized it, the system was totally federalized, with all excess cash sent to corporate. Managers had to make the case for all capital projects. The key question was, where's the next dollar best applied? And the company was rigorous and skeptical in answering that question. This discipline led Graham to a more cautious approach to physical plant investments than that of her peers. During the 1980s, other large newspaper companies spent hundreds of millions of dollars to install new printing and pre-press facilities that allowed shorter lead times and color printing. Graham, alone among major newspaper CEOs, held back, eventually becoming the last major publisher to rely on old-fashioned letterpress printing, deferring the expensive investment in a new plant until costs had dropped and the benefits had been definitively proven out by peers. Graham's approach to acquisitions was characterized by the twin themes of patience and diversification. Graham's years at the helm from the IPO on were characterized by generally rising earnings and multiples for media companies, punctuated by two severe bear markets, one in the mid-1970s and one in the early 1990s. In other words, the value of media properties fluctuated wildly over her tenure, and she proved herself to be an astute navigator of these trends. Graham's activity level was a mirror image of this macroeconomic picture, with two significant periods of stock repurchase and acquisition at the beginning and the end of her career, bookending a long period of inactivity that accounted for the vast majority of her tenure. With her board, she subjected all potential transactions to a rigorous analytical test. As Tom Might summarized it, acquisitions needed to earn a minimum 11% cash return without leverage over a 10-year holding period. Again, this seemingly simple test proved a very effective filter, and as Might says, very few deals passed through this screen. The company's whole acquisition ethos was to wait for just the right deal. As we've seen, during the acquisition frenzy of the 1980s, Graham generally stood aside, passing on numerous newspaper acquisitions, large and small. As her son Donald says today, the deals not done were very important. Another large newspaper would have been a boat anchor around our necks today. The only newspaper investment that the company made during the decade was telling: the purchase of a minority interest in Kohl's Media, the publisher of the Minneapolis Star-Tribune and several smaller dailies. The interest was purchased outside of an auction at an attractive price, based on a long relationship between the Graham and Kohl's families. Buffett played a key role in this discipline, functioning as Graham's allocation court of appeals and weighing in on all significant decisions involving capital investment. He was particularly involved with acquisitions. Buffett's style, however, was not directive, according to longtime board member and Cravath Swain partner George Gillespie. He would never say, "Don't do that," but something more subtle, along the lines of, "I probably wouldn't do that for these reasons, but I'll support whatever you decide." His reasoning, however, was invariably compelling and usually encouraged restraint. Most of the Post's acquisitions under Graham would lead the company into new businesses, unrelated to newspapers or broadcasting, where competition was less intense and valuations more reasonable. The most significant of these diversifying purchases were the Stanley Kaplan test preparation business, which provided a toehold in the education market, and the large 1986 Capital Cities acquisition, which established an entry point into the rapidly growing cable business. The Capital Cities cable deal was both very large and highly opportunistic, and, like the Kohl's deal, revealing of Graham's disciplined approach to acquisitions. When Capital Cities was forced by the FCC to divest its cable television systems following the ABC acquisition, Warren Buffett arranged for the Post to get an exclusive look at the transaction. Graham sensed a potentially compelling, proprietary opportunity. After a frenzied weekend, she and her team agreed to acquire the systems for an attractive price of $1,000 per subscriber. Importantly, no investment banker was involved. Graham's uncharacteristic buying spree during the recession of the early 1990s was also telling. With an exceptionally strong balance sheet, she became an active buyer at a time when her over-leveraged peers were forced to the sidelines. Taking advantage of dramatically reduced prices, the Post opportunistically purchased a series of rural cable systems, several underperforming television stations in Texas, and a number of education businesses, all of which proved to be extremely accretive to shareholders. As we've seen, stock repurchases were another major capital allocation outlet for Graham. Once Buffett explained the compelling math of repurchases, she initiated a buyback program and pursued it with vigor. Graham would add enormous value for her shareholders by buying in a massive amount of stock, almost 40% eventually, most of it purchased during the 1970s and early 1980s at single-digit PE multiples. As longtime investor Ross Glotzbach of Southeastern Asset Management says, "All buybacks are not created equal. She purchased in big chunks and at the right time." As Figure 5.2 shows, she was alone among newspaper executives in aggressively repurchasing shares and had to overcome strong initial resistance from her board. As George Gillespie says, in those days, buying back stock was very unusual. Buffett, who originally owned 13% of the company, never sold a share and today owns over 22%. Ironically, in the early 1980s, the management consulting firm McKinsey advised the company to halt its buyback program. Graham followed McKinsey's advice for a little over 2 years before, with Buffett's help, coming to her senses and resuming the repurchase program in 1984. Donald Graham reckons this high-priced McKinsey wisdom cost Post shareholders hundreds of millions of dollars of value, calling it the most expensive consulting assignment ever. On the broader topic of resource allocation, One of Graham's defining managerial traits was a unique ability to identify and attract talent to her company and her board. Although she could seem aloof, she had terrific people instincts, and as Alan Spoon told me, she was a consummate convener. While some of these people were paragons of the establishment, including directors such as former Defense Secretary Robert McNamara, and a succession of lawyers from the white shoe firm of Cravath Swaine in New York, many of her choices were decidedly unconventional. Two in particular stand out. First, in 1967, as we've seen, she tapped Ben Bradley, a young and relatively unknown Newsweek assistant managing editor, to replace longtime Post editor-in-chief Russ Wiggins. It's hard to overstate the unconventionality of this decision. Probably the most important personnel decision the head of a newspaper company makes is the choice of an editor-in-chief, the person with overall responsibility for the content and voice of the paper. Graham had concluded that she needed a younger editor, one more attuned to the rapidly changing political landscape and culture of the late 1960s. When she first mentioned the idea to the salty Bradley over lunch, he famously responded, "I'd give my left one for that job." Bradley, who had no prior newspaper management experience, could not have been more different from the distinguished professorial Wiggins. He would, however, prove to be a bold and intuitive editor who would lead the paper through the glory and turmoil of its 1970s scoops. He was also a magnet for attracting top young journalistic talent to the paper. This influx of talent, along with innovations such as the introduction of the country's first style section, led to consistent circulation gains through the 1970s and into the 1980s, providing a critical engine of profit growth for the company. Her second decision occurred during the severe bear market of 1974, when a new investor accumulated a large chunk of the Post stock, causing ripples of anxiety at the company. The board, in particular, was suspicious of this newcomer and his intentions. Graham had inherited a board composed of experienced local businessmen and cronies of her husband's. Although increasingly assertive in journalistic matters, she still frequently deferred to their judgment and advice on business matters. In this case, however, she struck out on her own and decided to meet with the new investor. To her credit, she immediately recognized his unique abilities, and against her board's advice, she invited the newcomer onto the board and moved to secure him as her key business confidant and advisor, instructing him only to be gentle and not hurt my feelings. The decision to welcome Buffett into the fold was a highly independent and unusual one at the time. In the mid-1970s, Buffett was virtually unknown. Again, the choice of a mentor is a critically important decision for any executive, and Graham chose unconventionally and extraordinarily well. As her son Donald has said, figuring out this relatively unknown guy was a genius was one of the less celebrated, best moves she ever made. A third personnel decision, more conventional but no less important, involved the hiring of Simmons in 1981. Given her inexperience with operations, the chief operating officer post was a particularly crucial and difficult position to fill. It took Graham a long time to find the right person for the role. She was demanding and not shy about making personnel changes, and had fired 4 COOs during the 1970s before finding Simmons. Over the next 10 years, he would proceed to dramatically tighten operations and improve margins at both the newspaper and the broadcasting divisions. Simmons shared Graham's bias toward decentralization, and with her support, wasted little time in putting the right people in key seats at the operating divisions. He also gave his managers great autonomy and tied their compensation to performance relative to peers. The Post Company had a historical bias toward decentralization and lean corporate staffing that went back to Eugene Meyer and Phil Graham, both of whom were highly confident in their own judgment and did not feel the need to surround themselves with many advisors. This tendency would become more professionalized and pronounced under Katharine Graham and Simmons. Graham worked hard to identify the best people and then was very comfortable leaving them alone. Her son Donald, under the influence of Buffett and Dan Burke, would continue and extend his mother's historical emphasis on decentralization. He told me that today he believes the Post Company is one of the most decentralized businesses in the country. Having watched her father hand over day-to-day management of the paper to her 31-year-old husband, Graham was also unafraid to give responsibility to promising managers at very young ages. Tom Might, who would later run the company's cable operations brilliantly, was given responsibility for the largest capital project in the company's history, a new printing plant in Springfield, Virginia, at age 30. He would bring it in 30% under budget. Alan Spoon was made COO of the company at 39, Jonathan Greer was made CEO of the education division at 29, and Donald was made publisher of the Post at 33. Despite her success, Graham was plagued by occasional bouts of self-doubt well into her nearly 30-year tenure as CEO. Fortunately, she was also strong-willed, independent, and comfortable making controversial, unconventional decisions, whether they involved refusing the demands of recalcitrant strikers, not buckling under to repeated threats from the Nixon administration, or ignoring other newspaper executives when they questioned her obsession with buying her own stock and her timidity in making acquisitions. In the end, this neophyte CEO left a journalistic and financial legacy that would be the envy of her peers, and she did it with great style and panache. As Ben Bradley told me with a wistful grin, she was just so much fun. Postscript: A Tale of Two Companies. It would be hard to find a business that has had a more dramatic fall from grace over the last 20 years than the newspaper business. Once Warren Buffett's paragon of an impregnable, wide-moat business with unassailable competitive advantages in local advertising markets, the business has long been in secular decline, with the largest papers struggling to remain profitable in the face of new competition for advertising from online players like Google. Several sizable chains declared bankruptcy over the last several years, and the industry's stock prices have reflected this long and dramatic decline, falling over 60% in the last 8 years. The Post Company, under Donald Graham's leadership, has certainly not been immune to these secular headwinds. It has still, however, managed to outperform its peers, losing only 40% of its value over the same period, thanks to generally strong performances from its non-publishing businesses. Again, CEOs can only play the hands they are dealt, and Donald Graham, as the CEO of a large newspaper company, was dealt tough cards, although, thanks to his mother's diversification efforts, significantly better ones than his peers. He has, however, played them substantially better than his peers by adhering to the tenets of his mother's approach, making selected acquisitions, aggressively and opportunistically repurchasing stock, including 20% of shares outstanding between 2009 and 2011, and keeping dividend levels relatively low. In contrast, over the same period, the other well-known, publicly traded, family-owned Northeastern newspaper company, the Sulzberger's New York Times Company, overpaid for an internet portal, Ask.com, built an elaborate new corporate headquarters building in Midtown Manhattan, and lost almost 90% of its value. Chapter 6. A Public LBO, Bill Sturritz and Ralston Purina. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. Warren Buffett. For most of the last 50 years, the large packaged goods companies, including household names such as Campbell's Soup, Heinz, and Kellogg, were considered the bluest of blue-chip stocks for their attractive combination of predictable growth, recession resistance, and reliable dividends. These companies had long been paragons of financial conservatism, using little leverage, reliably paying dividends, and rarely repurchasing shares. Most of them had followed fashion and actively diversified during the 1960s and 1970s in the quixotic pursuit of synergy, and many had ended up in restaurant and agricultural businesses in search of the elusive benefits of vertical integration. Ralston Purina was fairly typical of this group. In the early 1980s, Ralston was a Fortune 100 company with a long history in agricultural feed products. During the 1970s under CEO Hal Dean, the company had followed the same path as its peers, taking the enormous cash flow provided by its traditional feed businesses and engaging in a diversification program that left it with a melange of operating divisions, ranging from mushroom and soybean farms to the Jack-in-the-Box chain of fast food restaurants, the St. Louis Blues hockey team, and the Keystone Ski Resort in Colorado. When Dean announced his retirement in 1980, the company's stock price had not moved in a decade. After Dean's announcement, Ralston's board conducted a thorough search for his replacement, involving a wide slate of internal and external candidates. As the search unfolded, a number of top national candidates emerged, including Tom Wyman, later CEO of CBS. Late in the process, a lesser-known candidate, a longtime company man who was not even the lead internal candidate, improved his chances dramatically when he submitted an unsolicited memo to the board outlining in detail his strategy for the company. After reading it, influential director Mary Wells Lawrence, founder of the Wells Rich Green advertising agency, telegrammed back, "Bullseye." Within days, that candidate, Bill Sturritz, had the job. Bill Sturritz's career trajectory differs from that of the other CEOs in this audiobook. He was an insider, having spent 17 years at Ralston before becoming CEO at the age of 47. This seemingly conventional background, however, masked a fiercely independent cast of mind that made him a highly effective, if unlikely, change agent. When Sturritz assumed the CEO role, it would have been impossible to predict the radical transformation he would effect at Ralston and the broader influence it would have on his peers in the food and packaged goods industries. Sturritz had an unusual educational background for a CEO. He had an interrupted undergraduate experience, attending the University of Arkansas for only a year before leaving for a 4-year stint in the Navy when his funds ran out. During his years in the Navy, he honed the poker skills that would eventually pay for his college tuition. After the Navy, he returned to college, completing his degree at Northwestern, where he majored in business studies. He never earned an MBA. Repeatedly labeled cerebral by his colleagues and Wall Street analysts, he did, however, receive a master's degree in European history from St. Louis University in his mid-30s. After Northwestern, he had worked at the Pillsbury Company, starting as a field rep placing cereal on store shelves in northern Michigan. One of his largest accounts was an Indian reservation. Sturritz believes this grassroots experience was essential in helping him understand the nuts and bolts of distribution channels. He was subsequently promoted to product manager, a position that gave him broader exposure to consumer packaged goods, CPG, marketing. Wanting to understand media and advertising better, he left after 2 years for the Gardner Advertising Agency in St. Louis. At Gardner, he showed an early interest in quantitative approaches to marketing and was a pioneering user of the nascent Nielsen rating service, which helped give him a detailed understanding of the relationship between market share and promotional spending. Sturritz joined Ralston Purina in 1964 at age 30 and was assigned to the grocery products division, pet food and cereals, long considered the red-headed stepchild within Ralston's large portfolio of businesses. He worked there for several years in positions of increasing responsibility, becoming general manager of the division in 1971. During his tenure, the business grew dramatically, with operating profits increasing 50-fold through a relentless program of new product introductions and line extensions. Sturritz personally oversaw the introduction of Purina Puppy and Cat Chow, 2 of the most successful launches in the history of the pet food industry. For a marketer, Sturritz was highly analytical, with a natural facility for numbers and a skeptical, almost prickly temperament. These traits had helped him at the poker table and would serve him well as CEO. On assuming the CEO role in 1981, Sturritz wasted little time in aggressively restructuring the company. He fully appreciated the exceptionally attractive economics of the company's portfolio of consumer brands and promptly reorganized the company around these businesses, which he believed offered an attractive combination of high margins and low capital requirements. He immediately began to remove the underpinnings of his predecessor's strategy, and his first moves involved actively divesting businesses that did not meet his criteria for profitability and returns. In his early years at the helm, Sturritz sold the Jack in the Box chain of fast food restaurants, the Mushroom Farms, and the St. Louis Blues hockey franchise. The sale of the Blues in particular put Wall Street and the local business community on alert that the new CEO would be taking a radically different approach to managing Ralston. Sturritz proceeded to sell other non-core businesses, including the company's soybean operations and miscellaneous restaurant and food service operations, leaving Ralston as a pure branded products company. In this regard, he was not unlike Warren Buffett in the early days at Berkshire Hathaway, extracting capital from the low-return textile business to deploy in much higher-return insurance and media businesses. Starting in the early 1980s, Sturritz overcame initial board resistance and initiated an aggressive stock repurchase program. He was alone among the major branded products companies in pursuing buybacks, which he believed could generate compelling returns, and they would remain a central tenet of his capital allocation plan for the remainder of his tenure. Starting in the mid-1980s, after the initial round of divestitures, Sturritz made 2 large acquisitions totaling a combined 30% of Ralston's enterprise value, both of them largely financed with debt. The first added Continental Baking, the maker of Twinkies and Wonder Bread, to Ralston's stable of brands. Sturritz bought Continental from the diversified conglomerate ITT, where it had languished as the company's lone packaged goods business. Under Ralston's management, distribution was expanded, redundant costs were eliminated, new products were introduced, and cash flow grew significantly, creating significant value for shareholders. Next, in 1986, Sturritz made his largest purchase ever, acquiring the Energizer battery division from Union Carbide for $1.5 billion, equal to 20% of Ralston's enterprise value. Union Carbide was struggling in the wake of the Bhopal disaster, and its battery business, despite a strong brand name, had long been a neglected, non-core operation. Like ITT, Union Carbide was a motivated seller lacking in consumer products marketing expertise. Sturritz prevailed in an auction, paying an admittedly full price for an asset he felt had a uniquely attractive combination of a growing duopoly market and undermanaged operations. As he had at Continental, Sturritz moved immediately to improve Energizer's products and marketing, including the creation of the famous ad campaign featuring the eponymous bunny, enhance distribution, and eliminate excess costs. With this series of actions, the first step in Sturritz's transformation of Ralston was complete. By the late 1980s, the percentage of Ralston's revenues coming from consumer packaged goods had risen to almost 90%. This transformation had a remarkable effect on the company's key operating metrics. As the business mix at Ralston shifted toward branded products, pre-tax profit margins grew from 9% to 15%, and return on equity more than doubled, from 15% to 37%. When combined with a shrinking share base, this produced exceptional growth in earnings per share and returns to shareholders. Throughout the balance of the 1980s, Sturritz continued to optimize his portfolio of brands, making selected divestitures and add-on acquisitions. Businesses that could not generate acceptable returns were sold or closed. These divestitures included underperforming food brands, including the Van de Kamp's frozen seafood division, a rare acquisition mistake, and the company's legacy agricultural feed business, Purina Mills, which had become a commodity business with chronic low returns and limited growth prospects. His add-on acquisitions focused on the core battery and pet food brands, particularly in under-penetrated international markets. All these decisions were guided by a careful analysis of potential returns for shareholders. Throughout the 1990s, Sturritz focused on continued opportunistic stock buybacks, occasional acquisitions, and, significantly, the use of a relatively new structuring device, the spin-off, to rationalize Ralston's brand portfolio. Sturritz came to believe that even with a relatively decentralized corporate structure, some of the company's businesses were not receiving the attention they deserved, either internally or from Wall Street. To rectify this and to minimize taxes, Sturritz became an early user of spin-offs. In a spin-off, a business unit is transferred from the parent company into a new corporate entity. Shareholders in the parent company are given equivalent pro rata ownership in the new company, and can make their own decisions about whether to hold or sell these shares. Importantly, spin-offs highlight the value of smaller business units, allow for better alignment of management incentives, and, critically, defer capital gains taxes. Sturritz began this program with the 1994 spin-off of a collection of smaller brands, including Chex cereals and the ski resorts, into a new entity, Ralcorp. He remained the chairman of the new entity, which had a separate board and 2 co-CEOs. Sturritz would continue to rationalize and optimize Ralston's portfolio with the 1998 sale of the company's remaining agricultural businesses, including the fast-growing protein technology business, for a record price to DuPont in a stock deal, again avoiding capital gains taxes. His last move, and the largest by far, was the spin-off of Energizer Holdings in 2000, which at the time had an enterprise value equal to 15% of the company's total value. These spin-offs have all performed exceptionally well as independent publicly traded companies. Rawlcorp, originally a collection of neglected assets, today has an enterprise value of $5 billion. This series of moves left Ralston at the dawn of the new millennium as a pure-play pet food company, the dominant player by far in the U.S. market. It did not escape Sturrotz's attention that pruning unrelated businesses might make the company's core pet food brands more attractive to a strategic acquirer, and in 2001, the company was approached by Nestlé. After extensive negotiations, which Sturrotz characteristically handled himself, the Swiss giant agreed to pay a record price for Ralston, $10.4 billion, equal to an extraordinary multiple of 14 times cash flow. This transaction was the capstone of Sturrotz's tenure at Ralston. During a period when all of his peers had excellent returns, Sturrotz's numbers were exceptional. Over his 19 years at the helm, Sturrotz's transformation of Ralston into a streamlined packaged goods company had a propulsive effect on the company's stock price. As Figure 6.1 shows, a dollar invested with Sturrotz when he became CEO was worth $57 19 years later, a compound return of 20.0%, comfortably surpassing both his peers, 17.7%, and the S&P, 14.7%. The nuts and bolts. Michael Mauboussin, now a well-respected investor at Legg Mason, covered Sturrotz and Ralston Purina as his first research assignment at Drexel Burnham in the mid-1980s. He became fascinated by Ralston's maverick CEO and did an early comprehensive research report on the company, building on the work of his mentor, Alan Greditor, a rare Wall Street analyst whom Sturrotz respected. With Greditor's coaching, Mauboussin came to appreciate Sturrotz's unique approach to capital allocation. When asked to summarize what made Sturrotz different, Mauboussin told me, "Effective capital allocation requires a certain temperament. To be successful, you have to think like an investor, dispassionately and probabilistically, with a certain coolness. Sturrotz had that mindset." Sturrotz himself likened capital allocation to poker, in which the key skills were an ability to calculate odds, read personalities, and make large bets when the odds were overwhelmingly in your favor. He was an active acquirer who was also comfortable selling or spinning off businesses that he felt were mature or underappreciated by Wall Street. As longtime Goldman Sachs analyst Nomi Ghez emphasized to me, the food business had traditionally been a very profitable, predictable business, generally characterized by low growth. Alone among public company CEOs, Sturrotz saw this combination of characteristics and arrived at a new approach for optimizing shareholder value. In fact, he fundamentally changed the paradigm by actively deploying leverage to achieve substantially higher returns on equity, pruning less profitable businesses, acquiring related businesses, and actively repurchasing shares. In doing this, he was echoing the techniques of the pioneering private equity firms, including Kohlberg Kravis Roberts, KKR, which had successfully targeted underperforming packaged goods companies, Beatrice Foods, and later RJR Nabisco, for some of the largest early leveraged buyouts, LBOs. In fact, Sturrotz was an underbidder on both Beatrice and RJR. He also made unsuccessful bids for Gillette and Gatorade. The primary sources of funds at Ralston during Sturrotz's tenure were internal cash flow, debt, and, particularly in the early years, proceeds from asset sales. Operating cash flow was a significant and growing source of funds throughout Sturrotz's time at the helm. Margins steadily improved under his management, reflecting both a shifting mix toward branded products and a leaner, more decentralized operating philosophy. By the time of the Nestlé sale, Ralston's margins were the highest in the packaged goods industry. Sturrotz was the pioneer among consumer packaged goods CEOs in the use of debt. This was a heresy in an industry that had long been characterized by exceptionally conservative financial management. Sturrotz, however, saw that the prudent use of leverage could enhance shareholders' returns significantly. He believed that businesses with predictable cash flows should employ debt to enhance shareholder returns, and he made active use of leverage to finance stock repurchases and acquisitions, including his two largest, Energizer and Continental. Ralston consistently maintained an industry-high average debt-to-cash flow ratio during his tenure, as Figure 6.2 shows. Sturrotz's approach to sales and divestitures evolved over time. He started by selling non-core businesses, like the mushroom farms and the hockey team, that did not meet his criteria for profitability and returns, and these asset sales were an important early source of cash for the company. In this regard, there were no sacred cows, including the ancestral feed business. Sturrotz knew what things were worth and would sell any asset for the right price, Mobison told me approvingly. During this period, he was focused on divesting non-core assets at the best possible prices and redeploying the capital into higher return packaged goods businesses like Energizer and the Continental Baking brands. However, Sturrotz eventually developed an appreciation for the tax inefficiency of asset sales and, as we've seen, began to use spin-offs, which he believed released entrepreneurial energy and creativity while deferring capital gains taxes. From the outset, Sturrotz had been a believer in decentralization, working to reduce layers of corporate bureaucracy and giving responsibility and autonomy for the company's key businesses to a close-knit group of managers. He viewed spin-offs as a further move in this direction, the ultimate decentralization, providing managers and shareholders with an attractive combination of transparency and autonomy and allowing managers to be compensated more directly on their operating results than was possible in the larger conglomerated structure of the mother company. Sturrotz also proved to be a very astute seller. After his initial flurry of divestitures in the early 1980s, he made only 2 asset sales, both of them large. The first was the sale to DuPont of Ralston's protein business. DuPont paid a very high price for this business, and Sturrotz opted to take stock, thus deferring capital gains taxes. The other divestiture was the Nestle sale, which, as we've seen, resulted in a record price of over $10 billion. While Sturrotz acknowledges today that the price was very attractive, he regrets not taking stock, given the strength of Nestle's business and the capital gains tax incurred by his shareholders. Outside of the steady, year-in, year-out pattern of debt service, internal capital expenditures, and minimal dividends, Sturrotz's 2 primary uses of cash were share repurchases and acquisitions. His approach to both was opportunistic in the extreme. Sturrotz was the pioneer in the consumer packaged goods business when it came to stock buybacks. In the early 1980s, when he started to repurchase stock, buybacks were still unusual and controversial. As one of Ralston's directors said at the time, "Why would you want to shrink the company? Aren't there any worthwhile growth initiatives?" Sturrotz, in contrast, believed that repurchases were the highest probability investments he could make, and after convincing his board to support him, he became an active repurchaser. He would eventually repurchase a phenomenal 60% of Ralston's shares, second only to Henry Singleton among the CEOs in this audiobook, and he would earn very attractive returns on these buybacks, averaging a long-term internal rate of return of 13%. He was, however, a very frugal buyer, preferring opportunistic open market purchases to larger tenders that might raise the stock price prematurely. These purchases were consistently made when PE multiples were at cyclical low points. Sturrotz even personally negotiated discounted brokerage rates for these buybacks. Sturrotz believed buyback returns represented a handy benchmark for other internal capital investment decisions, particularly acquisitions. As his longtime lieutenant, Pat Mulcahy, said, "The hurdle we always used for investment decisions was the share repurchase return. If an acquisition with some certainty could beat that return, it was worth doing." Conversely, if a potential acquisition's returns didn't meaningfully exceed the buyback return, Sturrotz passed. In his approach to acquisitions, Sturrotz always sought an edge and focused on buying businesses that he believed could be improved by Ralston's marketing expertise and distribution clout. He preferred companies that had been undermanaged by prior owners, and, not coincidentally, his 2 largest acquisitions, Continental Baking and Energizer, were both small, neglected divisions within giant conglomerates. The long-term returns from these 2 purchases were excellent, with Energizer generating a 21% compound return over 14 years and Continental generating a 13% return over an 11-year holding period. Sturrotz focused on sourcing acquisitions through direct contact with sellers, avoiding competitive auctions whenever possible. The Continental Baking acquisition was sourced from a letter he sent directly to ITT Chairman Rand Ariskog, thus circumventing an auction. Sturtz believed that Ralston should only pursue opportunities that presented compelling returns under conservative assumptions, and he disdained the false precision of detailed financial models, focusing instead on a handful of key variables: market growth, competition, potential operating improvements, and, always, cash generation. As he told me, I really only cared about the key assumptions going into the model. First, I wanted to know about the underlying trends in the market, its growth and competitive dynamics. His protege, Pat Mulcahy, who would later run the business, described Sturtz's approach to the seminal Energizer acquisition. When the opportunity to buy Energizer came up, a small group of us met at 1:00 p.m. and got the seller's books. We performed a back-of-the-envelope LBO model, met again at 4:00 p.m., and decided to bid $1.4 billion. Simple as that. We knew what we needed to focus on. No massive studies and no bankers. Again, Sturtz's approach, similar to those of Tom Murphy, John Malone, Katharine Graham, and others, featured a single sheet of paper and an intense focus on key assumptions, not a 40-page set of projections. Sturtz, aware of the early LBOs in the packaged goods industry, consciously adopted a private equity-like mindset. His managerial worldview was neatly summarized by Mulcahy. Sturtz ran Ralston somewhat akin to an LBO. He was one of the first to see the benefit to shareholders of higher leverage as long as cash flows were strong and predictable. He simply got rid of businesses that were cash drains, no matter their provenance, and invested more deeply in existing strong businesses through mass